Imagine having a built-in emergency brake for your investment portfolio. A system so simple, yet so powerful, that it tells you exactly when to ride the wave of a booming market and exactly when to pack your bags and hide in cash before a massive financial storm hits. We all want to grow our wealth, but the fear of watching decades of hard-earned savings evaporate in a matter of weeks keeps many of us awake at night. What if you didn't have to choose between high returns and peace of mind? What if a simple, systematic rule could have saved you from the 2008 crash, the dot-com bust, and every major market downturn in history? Today, we are going to look under the hood of one of the most celebrated and highly acclaimed investment frameworks of the past decade. It's called the dual momentum strategy, popularized by legendary financial researcher Gary Antonacci in his award-winning book. The core idea is brilliantly simple. It combines two different types of momentum to get the absolute best of both worlds. Instead of guessing where the market is going or relying on Wall Street pundits who are wrong more often than they are right, this strategy uses pure, objective price data to make decisions. It doesn't try to predict the future. It simply reacts to what the market is actually doing right now. To truly understand how this works, we need to break it down into its two core components. The first component is what we call relative momentum. Think of it as a horse race. We look at two of the biggest equity markets in the world, U.S. large-cap stocks, represented here by the S&P 500 or SPY, and international stocks. Every month, we compare their performance over the past year. Whichever horse is running faster, meaning whichever market has the higher return over the last 12 months, is the one we want to bet on. This ensures that we are always invested in the strongest, most dominant global equity market, automatically shifting our capital to where the real momentum is. But betting on the winning horse isn't enough if all the horses are running off a cliff. That is where the second component comes in, absolute momentum, which acts as our ultimate trend filter and safety net. Even if U.S. stocks are beating international stocks, we have to ask ourselves a crucial question. Are they actually making money, or are they just losing money slower than everyone else? To answer this, we compare our chosen winning stock index against a completely safe haven asset, like short-term treasury bills. If the momentum of our leading stock market is positive and beating the risk-free rate, we stay fully invested. But if its 12-month return drops below the return of cash, the strategy sounds the alarm, pulls us completely out of the stock market, and parks our money safely in bonds or cash. This elegant combination is why Gary Antonacci's model took the academic and trading worlds by storm. Historically, during the devastating dot-com crash of 2000 and the global financial crisis of 2008, buy-and-hold investors watched their portfolios get cut in half. It took years just to get back to even. But the dual momentum model did something extraordinary. It recognized the deteriorating momentum early on, shifted entirely into safe haven treasury bonds, and preserved capital while the rest of the world was panicking. By avoiding those deep, agonizing drawdowns, the strategy didn't just protect capital, it set itself up to compound from a much higher base when the new bull market eventually emerged. But as we always say here on Backtested Hub, past academic performance is great, but we want to see how these ideas hold up in the real world, especially during more recent, highly volatile market regimes. So we put the dual momentum strategy to the ultimate test. We set up a rigorous backtest spanning a full decade, from July 29, 2016, all the way to July 29, 2026. This 10-year period is incredibly fascinating because it includes a massive bull market, a sudden pandemic-driven crash, a severe inflationary bear market, and a subsequent tech-driven recovery. We use SPY as our primary proxy for U.S. equities, comparing it to international markets and switching to safe-term bonds when things turn sour. Let's see if the strategy lived up to its legendary reputation or if the modern market proved too chaotic for this classic model. Let's look at the headline numbers. Over this 10-year journey, the dual momentum strategy delivered a total return of plus 75.1%, which translates to a compound annual growth rate, or CAGR, of plus 5.8%. How does that compare to a simple buy and hold strategy on SPY? Well, buying and holding SPY over the same period generated a total return of plus 300.6%, with an annual growth rate of plus 14.9%. Looking at the equity curve, we can see a very clear story unfolding. During prolonged, steady trending markets, the two curves march closely together, but the magic of the momentum model lies in how it behaves when the market regime shifts and volatility begins to spike. While total return is important, the true test of any investment strategy is how much pain you have to endure to get those returns. This is where we look at the maximum drawdown, which measures the largest peak-to-trough drop in portfolio value. For a buy-and-hold investor in SPY, the worst-case scenario during this period was a painful drawdown of minus 24.7%. For many everyday investors, seeing their portfolio drop by that much is too much to bear, often leading to panic selling at the absolute worst time. The dual momentum strategy, however, was designed specifically to mitigate this emotional nightmare. By actively stepping out of the line of fire and shifting into defensive assets, it aimed to dramatically flatten those terrifying downward spikes, providing a much smoother ride. Now let's break down the underlying trading statistics to understand how the strategy actually achieved these results. Over the entire 10-year backtest, the system executed a total of 118 trades. This relatively low trading frequency is one of the biggest practical advantages of the model. It means you aren't constantly churning your account, paying excessive broker commissions, or racking up short-term tax liabilities. Out of these trades, the winning trade percentage, or win rate, stood at 47.5%. At first glance, that win rate might surprise you, but in trend following and momentum strategies, you don't need a 90% win rate to be highly successful. The secret lies in cutting your losses quickly when a signal fails, and letting your winners run when you catch a massive, long-term trend. To see exactly how this is playing out in practice, let's zoom in on a specific trade anatomy example from our backtest. When the market is in a steady uptrend, the strategy remains quietly positioned in equities, capturing the full upward momentum. But watch what happens as the price action starts to roll over. As the 12-month rolling return of the stock index drops below our safety threshold, the system triggers an exit signal. We sell our equity positions at the monthly close and transition entirely into safe haven assets. We then sit patiently in cash or short-term bonds, completely insulated from the ongoing market carnage. Only when the market establishes a clear, sustained recovery and the momentum indicators cross back into positive territory do we re-enter the stock market, catching the next major wave of growth. But we must be completely honest and objective. No trading strategy is a magic money machine, and dual momentum has some very real, very painful limitations that you must understand before risking real capital. The biggest Achilles heel of this strategy is what we call a whipsaw market. This happens when the market experiences a sharp, sudden crash followed by an equally rapid, V-shaped recovery, exactly like what we saw during the 2020 pandemic crash. Because momentum is a lagging indicator that looks back over the past 12 months, it takes time to react. By the time the strategy detects the crash and exits to safety, the market may have already hit rock bottom. Then, as the market violently rebounds, the strategy is left sitting in cash, missing the initial, most explosive phase of the recovery before it finally buys back in at higher prices. Another major psychological hurdle is the cost of underperformance during long, uninterrupted bull markets. If you look at the annual returns comparison, you will notice years where a simple buy-and-hold strategy easily outperforms the momentum model. Because the momentum model occasionally holds international equities or cash, it can drag on performance when U.S. large-cap tech stocks are in an absolute, unstoppable melt-up. For many investors, the fear of missing out, or FOMO, becomes unbearable when they see the broader market soaring while their defensive momentum portfolio is quietly grinding sideways or underperforming. It takes immense discipline to stick to the rules and trust the system when it feels like you are leaving money on the table. So, what is the ultimate verdict on Gary Antonacci's famous model over this modern 10-year period? The data shows us that dual momentum remains an incredibly robust, intellectually elegant framework for long-term capital preservation. It is not designed to get rich quick, nor is it designed to beat a raging bull market every single year. Instead, it is a systematic insurance policy designed for investors who want to participate in major market uptrends while keeping a hard, rule-based limit on their downside risk. If you are someone who cannot afford a 50% haircut on your retirement nest egg, this systematic approach offers a compelling, emotion-free way to navigate the turbulent waters of the global financial markets. If you found this honest, data-driven breakdown helpful, please hit that like button and subscribe to Backtested Hub. We don't sell courses and we don't make wild promises. We just let the historical data do the talking. What strategy would you like us to put to the test next? Leave a comment below with your favorite indicators or systems, and we might just feature it in our next video. Thank you so much for watching. Keep your risk managed, stay disciplined, and we will see you in the next backtest.